Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Thursday afternoon, we have Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100. And Brian, I'm sure it's been a busy couple of days for you. We seem to have these 1% moves in either direction, which is something that we really have not seen since mid-October. So, it's been interesting to watch the volatility complex, what's happening in the indexes.
Yeah, we certainly we had a period there where the volatility was very low, so, very few 1% moves, and now that seems to be the norm. And good reason for it. We had Powell earlier this week was speaking, in front of Congress in his semi-annual address, and dropped the word transitory officially from the inflation topic, which was quite the quote, quite the headline. So markets certainly are responding to that, and particularly within the rates market. And equities as well.
Yeah, it's funny. I don't recall which Senate committee member it was, but he had said to Powell, from the moment we're born, technically everything is transitory. So I thought it was a little bit tongue-in-cheek as they were having these discussions. But Brian, I want to take a look at our first chart here. We'll pull up on your Bloomberg, the Nasdaq-100. I'm just curious to get your insights. As a technician, when you see these swings, 1.5%, one way or the other, volatility just doesn't mean going down. It can be on the upside as well with these kinds of moves. Does it make it more difficult for you as you're trying to establish these patterns?
I'm not sure if it makes it more difficult, but it certainly is eye-opening, and it gets you on your toes. We often see minor sell-offs, and the sentiment quickly turns very bearish. And for quite some time now, the buy the dip mantra, has been the way to go. And always at a certain point, things change, correlations change. And when that happens, typically, investors out there tend to lose money because the prior strategies that had been working for so long have now changed. And so they tend to have to react. And it just causes, it could even exacerbate the volatility that takes place.
Right. So with the chart that we're looking at right now, do you think that any top or bottom has been put in at this point, or do you expect more chop based on this pattern that you see here?
So the Nasdaq-100, relative to the other stock indices, the major U.S. benchmarks, it's still doing very well. If in saying that, to specifically answer your question, you could certainly make the argument here that this is a very symmetrical, topping pattern here for the Nasdaq-100. The common, dreaded head and shoulders pattern that so many people like to poke fun of because of the silly name. And so we certainly do have that kind of setup here. Now, we had a breakdown below the neckline of that pattern, which was yesterday's trading, and today we're kind of back above it, just barely. These topping patterns are also referred to as continuation patterns. So they don't always turn out to be bearish. It can be a consolidation within the broader uptrend, and that was something that we kind of saw back in the summer into the fall here, where this was looking a little toppy as well, but it kind of held that support. It dipped down below it on an intraday basis, and then that was in hindsight the ideal time to be buying. So we did, in this situation here more recently, we dipped down below it yesterday, we closed below it, and today we're back above it. So is this the start of a new uptrend? Time will have to time will tell. If we look at the weekly period chart, however, there's reasons to be optimistic and reasons to be concerned. The optimism is we're still holding above this rising trend line, and the pullback you can see is relatively very modest, maybe 5 to 6% we've seen off of last week's all-time highs. If you wanted to be concerned, you could say last week's candlestick pattern is a bearish engulfing pattern where the open close range, the body of the candle, completely engulfs the prior week's body. So that there, one, is bearish. And then two, if we want to look at the breadth of the index, we highlighted this last week. So last week, the Nasdaq-100, the breadth we had noted had dipped down to about 4.9 to about 5% of the members were making 52-week lows. Now this week, that's already declined to 11%. So we haven't seen that since March, April of last year, which we had a dramatic sell-off. So, but before that, we saw it in 2019. when it got to this level, and the index was down about 12%. And then we saw that again in late 2018, where there was a even bigger pullback within the index. Certainly doesn't mean that this time that has to happen again, but we are seeing an increasing number of companies underneath the hood of the index making new 52-week lows. So I'm still, based on that and based on the fact that we did break the neckline of this pattern right here, still kind of in a neutral camp that, we could certainly see more downside. And if I then compare that to other benchmarks within the US, the Russell 2000, the mid cap index, the micro cap index, even the Dow Jones, which seems to get a lot less attention these days. There's only 30 stocks in the index. It doesn't have the big growth names that the Nasdaq-100 has. But from a sentiment standpoint, I still think your average investor out there, people who maybe don't follow the market so often, when they see in the headlines that the Dow is down, X percentage points, and we know from a technical standpoint, it was the one large cap index to break the 200-day average this week. I think that potentially is reason to be concerned as well.
Right. I also think, Brian, especially with financial media, more on the mainstream side, when they're quoting the Dow Jones Industrial Average, obviously there's more points in it, if you will. So it's going to have more of a dramatic sound, like, OMG, the Dow's down 600 points versus the S&P or the Nasdaq-100, which doesn't have, as many points in it, if you will. But it really is interesting when you go back, when you're looking at the breadth in the market, and this is a pattern that I have not noticed before until you showed it to us. Usually at the end of the year, it typically is a little bit more quiet, but you're absolutely right. When it was 2018, 2019, we saw those dips end in November to December. 2020 was somewhat, and 21 was an anomaly, but it's interesting to see that pattern somewhat shaping up with that 11% number that you showed with the constituents hitting those 52-week lows.
Yeah, and I think 2018 is a good reference point, because the sell-off then was when we were in a rising rate environment, and going into fourth quarter, especially, months ahead of that fourth quarter of 2018, the bond market had been sending off some pretty strong signals that there was a deflationary concern. And we saw the euro dollars contracts invert. We then saw, steep flattening in the treasury rates market. And so I don't think you'd have many people this time around saying we're in a deflationary environment. But what was going on in 2018 was we did have the Fed messaging that where Jerome Powell, even to the fourth quarter, as that sell-off was underway, Powell was still getting out there in front of the market and talking a big hawkish type of policy going forward. And I think that exacerbated what we saw in 2018 in the fourth quarter, and in December especially. That was one of the worst Decembers that we saw in the last 90 years. So what's interesting now, and what the parallel is to now, is we finally have the Fed talking about dropping the word transitory and seemingly becoming more hawkish. And so that certainly, I think, spooked the markets. We'll see what the downside is from here, but I think there's some similarities there.
Well, we also had the trade war headlines in 2018 as well, and it's almost like the COVID headlines that we see now. The market's very predisposed to those, so it's almost like there's like one trend of the year that kind of infiltrates itself into the rising rate conversation as well. And it seems to be that this market is still very not shaky, but definitely feeding off of the headlines that we see coming through.
Absolutely, absolutely. COVID obviously is a huge topic, and as much as that news that was on Friday about the new strain from South Africa, before that, what was happening as well is cases have been rising in the northern hemisphere across the world.
Mm-hmm.
Germany is seeing new cases, new hospitalizations, new highs in those numbers. We're seeing higher numbers as well, and the concern, I think, is what's the reaction by policymakers, by government officials. And, they quickly reacted to what was happening in South Africa, shoot first, and then let's get the data later. And so we're seeing, increasing lockdowns. We're seeing increasing travel restrictions. So, that potentially is going to, decrease future economic activity. At the same time, it's going to hurt the supply chain issues. So there's your stagflation risk there increasing. So there's certainly reasons to be concerned about, what's happening, not just about the virus itself, but the response by policymakers to the virus.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.